The Fed is going to be front and center tomorrow. First, markets will be watching closely the language that comes with the FOMC's rate decision. And then secondly, in an effort for more transparency, Fed Chairman Ben Bernanke will hold his news conference. But is the Fed achieving the clarity that it wants? Recent headlines suggest maybe not. Fed watchers saying the central bank may still be falling short and causing confusion for the markets. So, is the Fed doing more harm than good? Well, here to discuss the Fed's communication strategy and what we expect, or what they expect to hear tomorrow from Ben Bernanke, is Advisors Capital Management's Chuck Lieberman, who will be giving our investors' take, formerly with the Fed, the New York Fed, and also MKM Partners Michael Darda will be giving the economist perspective. But Chuck, let me get the investors' perspective on this first. I mean, would you say that this choppy trading over the last several weeks or so, or several months, has anything to do with the confusion coming out from the Fed?
No, I think it has to do with the ebbs and flows of the data, the market struggling to figure out how much Europe might hurt the U.S. economy. Issues like that. I don't think the Fed's statements have lacked clarity. I think they're very clearly going to support the economy for as long as they feel necessary, as long as the unemployment rate is high, as long as inflation is low. They'll continue to keep interest rates very low and promise to keep rates low.
But you don't think that hasn't caused confusion, because you have 17 members of the FOMC who are giving their own rate forecasts, and you've had dissension among some of the Fed governors and presidents about when they see interest rates rising. That doesn't cause confusion?
Well, when would you ever have 17 economists in the same room who would give you the same forecast on the economy? The Fed represents a range of views. We know that. Some of the hawks, so to speak, have been fairly consistently hawks for many, many years. Some of the doves, likewise. We know that as well. They represent a range of views. We know where the center of gravity of the Fed is. We know what the Fed's position has been very clearly. So the fact that, let's say, President Fisher might have a very different view than President Evans, that's not news.
Hey, Michael Darda, when the press release comes out tomorrow about 2:15, obviously there are going to be a lot of paragraphs in there, a lot of people poring over individual words. What are you going to be looking for?
Well, certainly we'll look to see if there's any change in the Fed's tone. I really don't think we're set up for any kind of a surprise tomorrow. The Fed has a very cautious outlook for the economy. It believes that inflation will remain subdued. And as was mentioned before, we still have a very high unemployment rate. So the Fed, at the margin, most likely remains with a pretty cautious outlook. That 2014 commitment on rates will stay in the statement. So I'm really not looking for any waves tomorrow.
So should we be discounting any of these hawkish comments that we hear from various Federal Reserve presidents from time to time?
Yeah, I think we should discount those. The center of gravity on the Fed is really Fed Chairman Ben Bernanke first and foremost, and then probably Janet Yellen and Bill Dudley, all of which I would say are certainly on the more dovish side. And let's not forget, a lot of the hawks that are making noise have been looking for much higher inflation for some period of time, and their forecasts have not borne fruit. So I would basically ignore them.
Mike, you think Bernanke's doing a good job being transparent?
Well, I mean, there's what's optimal and, what Bernanke can actually deliver. He is trying to be a consensus builder. Certainly, I think we can take a look back at 2011 and be thankful that the Fed did not go the way of the ECB, misjudging the business cycle, raising rates when they should have been easing policy, and then throwing the economy into an unnecessary and avoidable recession. So it could certainly be worse here.
Chuck, let me get your take on that. I mean, does the market even want a more transparent Fed?
I'm not sure what the Fed could do to be more transparent. The Fed has been very direct. These conference calls will give investors or the press an opportunity to ask questions of Bernanke. His style has been very straightforward. He's addressed those questions pretty directly. So I'm not sure what the Fed could possibly do to be more transparent.
But in this era of more transparency that Bernanke is instituting, does it give more weight then to the members of the FOMC where they didn't have that before?
Well, I think it's an effort to try to be as transparent as possible, to show that the Fed is not hiding behind any curtains. I think the more interesting issue will be every time we get ebbs and flows in the data. When we see a strong economy, people will, on the outside, will of course question the Fed's ability to keep that promise of keeping rates down to 2014.
Right.
And the symmetrical statement would also apply, which is anytime we get weak data, as we saw, for example, a weaker employment report, people started trotting out this idea of QE3 all over again, as unlikely as that is. The Fed doesn't respond to 1 month's data. It's amazing how schizophrenic or manic depressive, maybe that's a better way to put it. It's the market that's the problem. The market is manic depressive. The Fed has been very consistent.
Mike, is the market manic depressive?
It does certainly seem that way recently. We had a very deep recession. We're coming out of it only at a moderate pace, so the market seems to be hypersensitive to the ebbs and flows of the macro data. Europe is obviously still a problem, and there seem to be a lot of fears clustered around the 2013 potential fiscal adjustments. So this is just the state of affairs I think we're going to have to live with for a while.
So but people often turn to the equity market as a good leading indicator, right, of the economy. Given what Chuck has just said, perhaps there's less and less of that in the markets, and it's not as good of an indicator.
Well, we've had a pretty good equity market this year. We're not even, more than 5% off the highs of the year, and there seems to be almost a sense of fear and panic that you would see in a market that's down 10, 15, 20%. So, I would say the market's done very well this year, and if we look at, the broad swath of macroeconomic data, it's consistent with a modestly above-trend economy, around maybe 3% real growth for this year. That's not a boom, but it's somewhat ahead of the consensus expectations.
Michael, thank you so much for joining us, Michael Darda, and also to Chuck Lieberman.